10 to 15 minutes on my prepared remarks, just to try and keep us to time, and I'm happy to take any questions you have afterwards. So my presentation is in 3 sections. In the first section, I'm going to talk a little bit about key ratings drivers for insurers, and in other words, what we look for when we're assessing insurance companies. So let me go straight into that. We set out our criteria in a single document, what we call, you can think of it as a one-stop shop, and you can get this document freely from our website. It's meant to be transparent, informative, and quite easy. It's a long document, but it's supposed to be quite easy to navigate. And if you were to look at it, you would get a good idea of how we review insurance companies, how we assess insurance companies when we assign credit ratings to insurance companies. The main part of that is what we call key credit factors, and I'll talk about that very shortly. But before I do, I also wanted to mention another document which supplements this main document that I'm talking about. And that's a document which talks about our national scale ratings criteria. And we use those, so we have the main international rating scale, global rating scale that we use generally across the globe. But in certain selected emerging markets, such as Kenya, to provide greater granularity and allow greater differentiation between companies, we also assign what we call national scale ratings. And that allows you to compare credit quality within a particular country. You can't compare them internationally, but they're useful when you're looking at companies and you're trying to compare them, rank them within a country. If anyone's particularly interested in that, I'm very happy to talk about that afterwards. So just coming back to the key credit factors that we have in our insurance criteria. We have 12 factors overall, 5 of them qualitative, 7 of them quantitative, which you can see listed on the slide here. Many of those are things that most of you, if you're looking at an insurance company, working out, if you're an intermediary, for example, working out whether you want to place business with a company, or whether you're just dealing with a company, whether you reinsure, many of these things are things that you would want to look at yourself. So hopefully it's not a surprise that we look at many of these things. In the interest of time, you'll be pleased to know I'm not going to go through all 12 of these factors, but I just want to highlight some that tend to be more important. When we do our analysis, we don't have equal weighting between these factors, so we're looking at each particular case, different factors will be more or less important. The ones I've circled in red here are typically the most important ones. So on your right-hand side, firstly, the quantitative factors, capitalization, how strong the capital is of a company, how financially leveraged a company is. That's usually, almost always an important factor for us when you're looking at companies. The other one I've circled in red on the right-hand side, financial performance, earnings, basically profitability, return on equity, combined ratio, all the other measures of profitability that you can think of. We look at those, very important in our analysis. On the left-hand side, under the qualitative factors, certainly in emerging markets or countries with not very high sovereign ratings, that first factor, sovereign and country-related constraints, can often be an important factor. It can act as a limit or cap on the ratings of companies within a particular market. And then the other point I've highlighted, the market position, size, scale, that's quite important for us in terms of how strong a business model a company has essentially. What's its pricing power, how good is its distribution, how efficient is it, and all those kinds of things. Very brief run through ratings criteria. The document I mentioned is something like 120 pages long, so it has a lot of detail, and I've just tried to capture that in 1 or 2 minutes here. In the next section, I'm going to talk about our views as an international rating agency, our views of the African insurance market. And actually, it's very interesting this morning listening to the different presenters, and just now Washington as well. In some ways, the impression I got was actually our perspective as a rating agency actually isn't that different from what I was hearing this morning. So I could almost just right now here tell you everything I have to say has almost been said by other people, so I'm going to stop here and sit down. But just maybe I shouldn't do that. I'll carry on just to bring out some of the key points, but I won't spend too much time on each of the points. Africa, state the blindingly obvious, is a continent. It's not a country, obviously. So the point I want to make there is actually, yes, you can think of Africa, the African insurance markets, but really, I think you have to think about different markets. Each individual country, each individual market has different characteristics. And it's really in the space of 10 minutes, you can't talk about all of those countries. So I'm going to focus on two particular markets, Nigeria and Kenya. But before I do that, I did want to bring out some of the similarities that there are between the different markets in Africa. And here on this slide, I'm focusing particularly on sub-Saharan Africa. Actually, if you look at the slide, this is the point I was making just now, that the points the other speakers were making this morning, I think are very much points that I've got here to make. Insurance penetration, we heard a lot about insurance penetration, low insurance penetration. I think insurance has an important role to play in society, in helping businesses, individuals to manage risk and to prosper. And also in supporting the development of, to support investment and capital markets as well. But to change this low insurance penetration requires some kind of catalyst. I'll come back to that shortly. The other points I've got here around structural challenges to growth, around political instability in different parts to different degrees. Poverty, I think, and we've heard that's something we heard about a lot this morning as well. What percentage of population can you actually target with insurance? I think that endemic poverty, I think, is a big structural challenge for growing insurance. In terms of fragmentation and how crowded markets are, I think that's quite a challenge as well. I think for insurance, and it's very much in tune with what other people have said, for insurance to be truly successful and create value for all stakeholders, they need more scale, really, to provide real value and to create real value for all stakeholders, not just for the owners, but also for customers, employees, intermediaries, and so on. And just to bring out this point about fragmentation and competition, we've got a slide here about Kenya, firstly, as an example. And I'm comparing it with the South African market. So I think the point's been made already about the Kenyan market being competitive. It's characterized by nearly 50 insurers operating in the market, which compares actually to about the same number of primary insurers in South Africa. Okay, so the same number of companies. But if you then look at the premiums you have shown at the bottom of the slide there, the Kenyan insurance companies are chasing a much smaller insurance market. So those same 49 are chasing a market that's nearly 30 times smaller than South Africa. So let's just make the point a slightly different way here, that the market is fragmented. The top 10 insurers, at least by assets, only cover 66% of total assets, which if you compare with South Africa, the top 10 cover 85%. And actually in South Africa, if you look at the life side, it's actually really only about the top 5. The top 5 essentially cover more or less 100% on the life side. Similar story in Nigeria. I'm not going to go through the figures here, but essentially it's the same story in terms of similar number of insurers compared to South Africa. And the reason, obviously, just to make, maybe I should be clear, the reason I'm comparing in South Africa really is because it's the most developed market in Africa, and actually one of the most developed globally, really. Very similar story here with Nigeria, as I say, in terms of similar number of insurers chasing a market that's something like 30 times smaller. Just maybe coming back to insurance penetration here. So this is showing, as the speaker mentioned this morning, essentially this is premiums as a percentage as GDP, just to make sure we're all on the same page in terms of what I mean by insurance penetration. And you can see quite a big difference there. Typically quite low rates, except for South Africa, which has one of the highest penetration rates. And it's not just in Africa, actually. The South African market, mainly because of the life insurance side there, has one of the highest penetration rates, insurance penetration rates in the world, not just in Africa. Kenya actually does quite well here on this slide in terms of insurance penetration relative to the selected countries I'm showing on this slide. Nigeria, which is one of the largest economy, I think the largest economy in Africa, very low insurance penetration, as you can see on the left-hand side of the slide there. Just going back to the point this morning about growth in premiums, premiums have been growing, but high nominal growth in premiums isn't really enough in itself to increase insurance penetration. It sounds like an obvious point to make, but just if you look at the slide here, on the left-hand side, I'm showing on an indexed basis how premiums have grown in Kenya and Nigeria in nominal terms, essentially. But then on the right-hand side, I'm showing a chart of insurance penetration in Kenya, and it's stayed about the same despite growing premiums, and actually it fell in 2014, but that's only because of the rebasing of GDP, which I think made a difference of something like 25%. When the premium stayed the same, but the denominator changed as the GDP was rebased upwards. On this slide, what I'm showing here is it's a reasonably widely used S-curve concept of development of insurance versus GDP growth per capita. So what it's showing is on the x-axis the insurance penetration as a percent of GDP, on the y-axis at the bottom the GDP per capita, and essentially saying when GDP per head increases, insurance penetration has a tendency to increase. This kind of slide is one that Prudential PLC uses quite a lot to explain the development of their markets in Asia, to illustrate how different countries in Asia, where they are on at different stages on the curve, as it were. So in terms of improving insurance penetration, there are essentially two dimensions, I think. One is to move along the curve. So in other words, as the GDP per capita increases, you would expect insurance penetration to naturally increase as well. So you're moving along the curve. But that's quite hard to do. It takes time. It's going to take GDP per capita is not going to increase significantly from one year to the next, really. So the other dimension is to increase to get better relative to the curve. But that needs a catalyst, really, some kind of catalyst to get better. So Kenya actually is higher than the curve here, in this illustrative curve. But what could that catalyst be to get you above the curve, to do better than the curve? I've listed some things here, and I think all of those points have been made by earlier speakers. One around, we talked earlier on about consolidation, the need for scale, the role that external capital has to play, not just in providing capital as such, but in terms of improving business processes and providing know-how. And the second set of bullet points there, execution, application of effective business processes. I think that point was well made earlier today as well. So it's about increasing, industrializing processes, improving efficiency, and the other point there, I was pleased to hear at least one or two speakers earlier talking about customers and putting a focus on customers rather than just what's in it for the insurance company or for the intermediary. What are you doing for the customers? I think that's going to be an important part, which plays into the last point I have on the slide there, which is about increasing the trust. At the moment, there isn't really, to be honest, there isn't much trust in insurance. Customers don't really have much trust in insurance in most markets, really. And I think that needs to change. And a prerequisite for that, I think, is excellent customer service, paying claims quickly, that kind of thing. Just a few examples of some M&A activity, but we had earlier on, I think Ben Kajwang had a very detailed slide, so I'm not going to go through M&A activity myself. What I try to do here is, and really more is for you to think about later, I try to compare Kenya versus Nigeria on various different market factors here. And I'm not going to, in the interest of time, I'm not going to go through all of those, but what the circles are showing, this is a subjective assessment. This is Fitch's subjective assessment, so you might have equally valid views about how to score each of these things. So the circles are showing where each factor stands today. Green means it's good, amber means it's neutral, it's okay, and red means it's negative. And the arrows, outlook, are showing the direction of that factor, where we expect that to head in the future. So, for example, just to maybe pick out profitability, the first one there, both Kenya and Nigeria, we think the profitability is actually good in the markets. In terms of direction, outlook, we think it's going to stay about the same. It's not going to fundamentally change. And then I've done a similar comparison of Kenya versus South Africa. I mean, the only point to bring out here is you see a lot more green circles for South Africa, which is perhaps not a surprise. But on the other hand, for Kenya, you see a lot more up arrows in terms of looking ahead. We expect improvements in most of those factors. That's it for my prepared remarks. I just want to finish with one little... This morning, my colleagues realized I'm speaking at a conference here. A number of them saw a story in the Financial Times this morning, and all of them sent me the article. So I want to just share the headline with you, and that's what I'm going to leave you with as my closing remark. It says here, Africa's insurance market, a giant waking up. I'll leave you with that thought.